My name is Melissa Beheimer. I'm with Brady Ware. I'm an audit manager. I work out of the Columbus and Dayton office. Corey Taylor is my co-presenter today. He works out of our Richmond, Indiana and Dayton office. Corey and I both work predominantly on not-for-profit organizations, and both of us do currently serve on boards, so this is a topic that hits home for us. So we were real interested in preparing for this presentation. I want to find out how many people here are board members, and then how many just work for a not-for-profit. And then everybody else is just the Brady Ware people that looked for a day out of the office. I get it. We'll take that. All right. I thought we would start today with discussing the legal duties of a board member. The board of directors of nonprofit corporations are ultimately responsible and accountability for the conduct and performance of an organization. Boards regularly delegate this work to staff, executives, but yet they cannot delegate their responsibility. From a legal perspective, nonprofit boards have individually four fundamental duties that they must follow. So we're going to start going over those. Duty of care, exercising a judgment that is reasonable and prudent person would exhibit in the process of making informed decisions, including acting in good faith consistent with what is in the best interest of the organization. The law does recognize that board members are not always going to make the correct decisions, but they do hold you accountable for being attentive, diligent, and thoughtful in your decision-making policies. So you do have some recourse. They realize you're going to make mistakes, but they do want you, you have to be able to show that you're attending your board meetings and you're making thoughtful decisions along the way. Duty of loyalty calls upon the board and its members to consider and act in good faith to advance the interests of the organization. In other words, board members will not authorize or engage in transactions except those with the best possible outcomes for the organization. This standard constrains board members from voting or even discussing on decisions where they have a perceived or real conflict of interest. Duty of compliance requires obedience to the organization's missions, bylaws, and policy, as well as honoring all the terms and conditions of other standards that would be appropriate, such as laws, rules, and regulations. Duty to manage accounts. Board members are responsible for the charity's financial stability and accountability. They do this primarily by establishing procedures to help the organization operate in a fiscal manner. Board members are obligated to honor these standards with regard to all decisions and actions, and those who do not may be subject to civil and even criminal sanctions. So keeping our legal duties in mind, we're going to discuss these four specific topics today: legal compliance and public disclosure, effective governance, strong financial oversight, and responsible fundraising. We will leave a little bit of time at the end. I know we're running a little late for questions, so kind of jot them down or keep them in your mind for the end. Legal compliance and public disclosure. Laws and regulations. Board members should be familiar with the laws and the legal framework with which the organization functions within. There should be a process to inform board members of what those laws that the organization are required to follow. Health and welfare organizations, for example, must follow HIPAA rules, and so the board should be aware of what those laws are and how the organization plans to work within that legal framework. The bylaws also represent a legal document, and this should be a guide for all board members. It should be the first document that's given to new board members because it lays out how the board should be operated, organized, the positions, what those positions requirements are. So it should be a living document that you just don't, hand out once and not discuss. And Corey will discuss more about your bylaws. Code of ethics. An organization's code of ethics, standards beyond their legal requirements, not just doing things right, but doing the right thing. Board members should question, what are the values does the organization want to exemplify, and how are they sharing those values with all the staff and volunteers? Have we articulated our values to everyone? What steps should we take to integrate our code of ethics into our culture and our organization? Do our policies and procedures reflect our code of ethics? These are questions as board members you need to make sure when you're making policies that you're keeping your code of ethics and what you guys believe in, and making sure that you're getting that articulated in all your policies. One simple way, and I know a lot of organizations do this, to share their values on a regular basis, is an annual code of conduct certification. And it's given to all your staff and ask them to sign that yearly so everybody's on the same page. Ethics should be a regular topic at your board meetings, and it must start at the top. The board and the management must be the leaders in this, setting the tone. Conflict of interest. All conflicts of interest, potential, perceived, and material, should be addressed by the board. A conflict of interest is not necessarily illegal or unethical, but how the board of directors chooses to deal with these conflicts determines how these are viewed by the public. We'll discuss board independence later, but it's important that there is a formal process to identify potential conflicts before every board meeting, before every vote, and that if members do have conflicts, they recluse themselves from the discussion and the vote. There should be a policy to guide staff and board members need to sign an annual conflict of interest disclosure. This form should say, these are the potential conflicts. I work for this bank, you do banking with that organization. So these are the kind of conflicts that need to be identified on a yearly basis. The 990 also asks for those conflicts to be disclosed, so it's important that you have that filled out every year. As I said, a classic example is you have a banker on your board and you're obtaining funding or you do your banking through that organization. That's a conflict that board member should not be involved in any vote or discussion. It is an IRS hot button issue. So the 990 does question, does the organization have a written conflict of interest policy? Does it require officers, directors, and key employees to annually disclose interests that could give rise to conflicts? And inquires how an organization monitors and enforces that compliance. So it's got like 4 questions on this area. So the IRS is on it and they want to know. And then if there are potential conflicts, they want those disclosed. Whistleblower policy. All organizations should have a process for staff and employees to safely report unethical and illegal acts. Could be as simple as an open door policy, giving them access to board members, or in the case of larger organizations, perhaps you do need a hotline. Sarbanes-Oxley has 2 provisions that do apply to not-for-profit organizations. Section 1107 imposes criminal liability against anyone who knowingly, with the intent to retaliate, takes action harmful to any person, including interfering with their lawful employment or livelihood, for providing law enforcement officers any truthful information regarding the commission of a federal offense. So that's like the spiel they give you, the IRS does. Basically, you can't retaliate against people who disclose information in an investigation. Despite the fact that nonprofit organizations are not required to adopt a whistleblower policy, evolving consensus in the nonprofit sector is that it's appropriate for charitable organizations, at least those of a certain size, to adopt a policy that applies broadly to illegal and unethical acts. Adopting such a policy demonstrates an organization's commitment to promote the highest standards of ethical conduct and good governance, and makes clear that there'll be no retaliation against anyone who does report. Again, although it's not required, the 990 does question, do you have a whistleblower policy? I'm sorry, go ahead.
Okay, I want to make sure I'm following this
Yeah.
correctly. The nonprofits are not required to have this policy,
Yeah.
but there is a provision to protect whistleblowers.
Correct. You can't retaliate. They basically spell out you can't retaliate against anyone who is a whistleblower. This is going back to the whole Enron situation. You don't have to have a written policy, but they're telling you can't retaliate against anyone who does.
I assume that means it's only in the context of the government having initiated a investigation, not an employee who I shouldn't say creates trouble. but
We don't have those.
The employee who perceives something as being,
Well, yeah,
Yeah.
I think it goes both ways, but then it does specifically say truthful information. So, if you do have an employee who is starting trouble and reporting things and it turns out to be not truthful, they're not protected under that clause. But if it is something that has actually happened, there is something illegal or unethical going on and they report it, then they are protected under the
reported
Sarbanes.
to who? Only government?
No, even
Internally?
even internally. Yeah, even internally. Yeah, that's basically what it's saying. And as I said, the 990 asks if you have a policy. For smaller organizations, a hotline might be a little excessive, but just a simple policy, would go a long way to make sure everyone feels protected. If something illegal is going on, you want to know about it. So you want to have some sort of mechanism that they can report that. And to stop here for a second, this is the second policy that I have pointed out that the 990 asks about. We do have a not-for-profit toolkit Brady Ware has developed, and it has sample policies in it. So if anyone is on a board that maybe doesn't have some of these policies and would like to get a copy of those, just see one of us after, and we'll get your card and make sure we send that toolkit to you. Okay. Document retention and destruction policy. This is the other part of Sarbanes actually that applies. Section 802, which makes it a crime to knowingly alter or destroy, mutilate, conceal, cover up, falsify any record or document with intent to impede, influence, an investigation. This is PwC shredding of the document. So, it falls into the line for the not-for-profits. Violators may be fined or imprisoned up to 20 years, so they take that pretty serious. This is a policy that gets everybody on the same page. I know a lot of not-for-profits don't have it. The 990 again asks, do you have a policy in place? And I serve on a board, and recently we had some turnover in our management, and I was helping clean up accounting records. And we had every bank statement and board minute from the 60s on. Probably not a document we needed to keep. We actually were an organization that made loans, and some of them had been written off, and I needed to substantiate some of them. Well, the executive director had shredded all those. She got rid of those. She kept the bank statements from the 60s, but I got rid of the loan documents because they were written off. She didn't have a document to guide her, so she made her own decisions. This is where this kind of document is important for the staff. The board should develop this policy so everybody knows what should be maintained, how long, and when should it be destroyed. Yes. Oh, I'm sorry. Go ahead.
before you move past this issue of destruction policy and legal documents, I have the understanding that minutes are legal documents.
I believe so.
I have ordinarily insisted that minutes accurately reflect the discourse during meetings. I have been in some organizations where they edit the minutes, and was it overkill on my part to leave the organization because I was concerned about this business of destroying documents, and I don't know, it just didn't seem ethical that the minutes were being edited.
Yeah, I would have a concern with that. I think a lot of boards don't understand how important the minutes are. I mean, they are questioned in the 990. Do you keep them? It's a document where if you're getting a loan, as auditors, and that's what I do every day. The first place I start is the board minutes. Was this loan approved? Did you have a big funder coming in? This is the place that, did you document how you've decided to pay your executive director? Did you do a compensation search? So, yeah, I definitely would have a problem if someone was editing those minutes and not maintaining all that information. That is the place, and it's the board's protection. You have the fiduciary responsibility. If those decisions are not documented, you don't have, how do you prove if something goes wrong that we lived up to our end of what was supposed to do. So I would agree that I would have a problem if those were, yeah.
Or isn't, in a sense, the fact that the board has to approve the minutes, isn't that a safeguard? That if it doesn't contain it, or it doesn't say it the way we said, that they do not approve it?
True, absolutely, absolutely. I mean, the board minutes are board minutes, and usually you have a staff member in there taking them, but, you know, when they start your meeting off and they ask everyone, have you read the board minutes, and do you have anything to change or add, or is anything wrong, you should take that very seriously. And then, yes, after those are approved, they should never be changed or altered. Yeah.
Well, the editing was usually happening in between meetings, so that by the time you got to the next meeting, the editing that a certain person wanted to occur took place, and only those who kept good notes would recognize
Something
this
was
is
different.
not
Yeah,
what occurred.
yeah, yeah. That probably sounded like some problems on that board. Okay, protection of assets. The full board is responsible for overseeing the organization activities. Fiduciary duties can lead to personal liability if it is proven that there were breaches in those duties. Board members should understand the risks that an organization faces, review those risks, and establish systems to manage the risk. Organizational risks vary based on the nature and the complexity of the organization, but all boards should at least annually review the risks, review the controls in place to protect the assets. I ask this question a lot. I always do a board member interview when we do our audits, and I always ask, have you discussed the risk that face the organization? And 9 times out of 10 I get a no, we didn't discuss that. You should be questioning, are the current checks and balances adequate to protect the organization against fraud and embezzlement? As board members, it has to be the most frightening thing that you deal with, is that on a day-to-day basis you're not there, but you have the fiduciary responsibility, so you have to make sure that there are internal control issues addressed. Many times the risk is higher in smaller organizations because there's little segregation of duties. You got one person doing everything. This is where the increased board oversight is required, your fiduciary responsibility. There is directors and officers insurance that can provide you some coverage for liability expenses as well as defense costs. This does provide you with a level of assurance that if something were to go wrong, the insurance is there. So if you sit on a board, that should be one of the first questions you ask to make sure that there is D&O insurance to cover you. Availability of public information. The board should understand what must be public information, what should be shared, and what must remain confidential. The IRS 990, 990T for the last 3 years must be made available to anyone who asks. The Form 1023 is also public information. If you're a covered entity under HIPAA, you need guidelines to cover confidential information, and obviously that takes you to a whole nother level of where you need to be. The Form 990 inquires about what is your process to make these documents available. We always suggest that you just put the information on your website. It's just the easiest way to share. The public has a right to know those organizations that are obtaining public funding or donations, how they use those funds to further their exempt purpose. Transparency equals trust. I have a lot of organizations that are leery about, we just don't want to share that information, but you should want to share it. You should be operating your not-for-profit at a level where you have nothing to hide, and that more information that you're given should make things come back to you in tenfold. So, the website is just an easy way to share that. And now we are on to effective governance. That's going to be Corey.
Good morning, everyone. My name is Corey Taylor. As Missy said, I'm an audit senior with Brady Ware. I've been with Brady Ware for about 6 years and work primarily in the Richmond office, but do service some clients both in Dayton and Columbus. So let's talk about effective governance. Board responsibilities. The board's fundamental responsibility is to satisfy itself that everyone connected, both directly and indirectly, with the organization understands its reasoning for existing. So why do we do what we do? This is typically documented in a mission statement. The board should periodically review this mission statement So we may have created one 5, 10 years ago. Is that still relevant today? Is that still the mission that we are going with? The mission statement and strategic direction should clearly express the organization's goals and those primarily served by the organization. So who are we serving? Who are we going after to provide services for? But along with who do we serve is what makes us distinct, special, and what compelling reason do we give donors, so those individuals, corporations, foundations that we want money from? What makes us different from our competitor down the street that might look just like us? So it's good to make ourselves distinct from our competitors. Our strategic direction serves as a guide for all organizational planning, board and staff decision making, volunteer initiatives, and again, setting priorities among competing demands for scarce resources. As I'm sure some of the organizations represented in the room may see, donors are being gone after time and time again with the state of the economy, so they're getting fatigued. So there are those scarce resources. So again, it makes it nice to have a good strategic direction, a good mission, and again, making yourself stand out against your competitor, if you will, down the street. Talk about board meetings. How often should the board meet? Well, we should look at our bylaws. What do our bylaws say? How often are we going to meet? Could be monthly, could be quarterly, every other month. It really depends on the needs of the organization. Also, you may look to sunshine laws in your state. A lot of those seem to think that an annual meeting is all you need, but I would venture to say that more often than once a year is key in having good board oversight of the organization. But again, it depends on the size of the organization and the involvement of the board within the organization. So here we pose a question. Do we need to have committees, or could the entire board review all aspects of the organization? Well, I think the answer depends. Depends on the size of the organization. It depends on how involved the board needs to be. Do we have top management? Do we have employees that can carry out the mission and the strategic direction, or is the board a little more involved? If we talk about committees, these are a few we've listed here that we typically see. A finance or investment committee, looking at the financial aspects of the organization. An audit committee, if you have an audit requirement, they would hire auditors and approve the audit each year. You might have a personnel committee to deal with HR type issues, a fundraising committee if you're looking to maybe do a capital campaign, or if you have an annual special event, something like that. Another committee not listed may be an executive committee, made up of maybe the top officers on the board. And looking at those committees, we want to look at their performance. Are they meeting regularly? Are they doing what we've asked them to do? Do we have too many committees? Do we need to condense some of them? So it's a good idea to look at our committees, to have them as a way to more in-depth look at different topics of the organization, and then they can report back to the full board a condensed, brief version. That way a meeting doesn't go from an hour into 3 and 4 hours based on discussion of certain topics. One thing to note also in your bylaws, you can talk about the authority of committees. Does a committee have the authority to act as if it was the full board? Well, I know I see that a lot where the executive committee could make a decision if the full board is not available for quorum or they can't get all the members together, that the executive committee could act as if they were the full board. So board size and structure. Again, I think as I've stated, there's a no one size fits all approach. It all depends on the size of your organization. Some general guidance suggests no less than 5 unrelated board members, but probably 7 or more is ideal. One thing I would throw out there is probably to do an odd number. That way when a vote takes place, there's no ties. So we don't have to address what do we do in that situation. If we have an odd number, we never can get into a tie situation. And a lot of times we see, talking back to committees, your executive director or your CEO may be an ex officio member, so they might help in some of the direction of some of those committee discussions, or might have some more insight to provide to committees if that person was not involved. But we ask, when is it too small? When is a board size too large? Again, it depends on workload, legal requirements. Our need for diversity is mentioned here, and I'll talk about that in a further slide. But I guess in looking at this slide, the answer would be it depends. So board diversity. Looking at a variety of skills, backgrounds, and expertise. Some different positions that people have that we typically see on boards. Us, accountants. Somebody who understands a 990, may understand audited financial statements, understand grant documents. They provide that expertise and that knowledge to help the organization make decisions around those items. Attorneys, if legal items come up, they may be able to represent the organization, provide guidance. Someone from the insurance industry, someone who has a fundraising, maybe a grant writing background. These are positions that you can get expertise and knowledge from people, and you don't have to pay them for it because that's their service and their duty as being a board member. Just a a quick example. I serve on a board in Richmond, and when I started being on the board, there was an insurance individual, and everybody else was from law enforcement or the prosecutor's office. Now, given the nature of the organization, that wasn't terrible that everybody mostly had a law enforcement background, but they had no accountant. And unfortunately, they had embezzlement. So I came in having an auditing background, was able to suggest some segregation of duties, some checks and balances, different things from my perspective that no one else on the board had and couldn't bring that level of expertise or knowledge to the board. So it's good to get a diverse group so that you have all aspects of the organization represented. And it allows the organization to make better decisions and the board to have a better direction on where the organization is going to go. Talk about board independence. Again, Missy talked about a conflict of interest policy. It might be good to have a no nepotism policy, forbidding favoritism shown to family members or friends who are related to board members or our top staff. So it's just another way of reducing conflicts. Again, as Missy stated, there should be an annual review of conflict of interest. If conflicts arise before that annual kind of recap is done, those should be brought to the board's attention, and a board member who has any conflict should, again, abstain from any voting and should excuse themselves from any discussions regarding those conflicts. Probably one of the next biggest job of the board, besides creating the strategic plan, developing the mission, is CEO evaluation and compensation. Now, the CEO is obviously the top employee of the organization. The board is the boss. They answer to you. They're not going to get the supports or the motivation that he or she may need except for the board, because a lot of times that person may be the bad guy. They may be looked down upon by the staff because they made a decision that people didn't agree with. So it's nice to have the board. They need to evaluate the executive director, the CEO. This could be subjective and objective. Do we have annual goals that he or she is trying to attain? And when we're looking at CEO evaluation and compensation, we want to look at comparability. If we're an organization in Columbus, Ohio, and there's a similar organization maybe in Columbus or another city of similar size, we're looking at those salaries and that compensation. Is it reasonable? Is it comparable? Are we paying them way too much, or are we paying them not enough? So we want to be good stewards of the organization's time and money, and really do a good evaluation of the CEO. One thing I did want to point out here, we got a line review of expenses and reimbursements. I did have some experience with an organization where the secretary of the top management official was approving the reimbursements and the credit card expenses. Now, I don't know about any of you, but I don't know what secretary or administrative person is going to tell their boss, nope, that's not approved or that's not legitimate. So again, this would be another function that the board, could be somebody from a finance committee or an executive committee, they're reviewing these expenses, credit card activity, to make sure they're reasonable, that they're prudent, and that they're using the organization's resources correctly. Again, we talked about a comparability study. There are IRS rules out there against excessive compensation, and there are excise taxes and penalties that can be levied against CEOs and board members who knowingly provide excessive compensation or benefits to their CEOs. Talked a little bit already about separation of duties. Just to note here on this slide that it's the CEO or the executive director, they manage the daily operations of the organization. And the board chair or board president, they lead the board in its governance duties. So unless there's a strong reason for the executive director also to be the board chair, we would recommend that these be two different responsibilities, that two different people lead both the day-to-day activities and the board. Again, the CEO could be an ex officio member of the board or a committee and provide some valuable insight. But again, we would recommend for good internal controls and segregation of duties that these positions be two different people. Talking about board education and communication, Missy hinted on this a little bit. Board members need to be provided with job descriptions. What is my job? What is my duty as a board member? What are my legal requirements? They need to have a clear description informing them of what is expected. And this could be in the form of, it could be in the bylaws, it could be a handout that's in a board packet. A board orientation is something that we suggest. And it's also not a bad idea for continuing education. So maybe the board gets together and has an annual retreat, or they look for outside classes, maybe such as the one that we're putting on here, other trainings to just further enhance their knowledge of board duties, of their responsibilities as a board member. But again, it's also communicating to the board as the organization changes that they should be made aware from those within the organization of those changes. So it's just a continuing education of the board members. And lastly, we note financial commitment. If someone's on your board, I would assume probably 9 times out of 10, they're passionate about your mission, your focus, what you're doing. It's not a bad idea to ask them for money. They should be expected, I think, to make a financial commitment to your organization. That's not a bad thing. Talking about evaluation of board performance. Here we talk about how are board members doing their job? Are they routinely missing meetings? Do they not show up? Do they just sit back and let everybody else do all the work and they're just there because they were voted to be a board member because they knew another board member? So we need to have an objective, subjective evaluation where a board member honestly looks at themselves. How is my performance? And the other board members looking at each other. How is, Susie's performance versus mine or everybody else's? And is there something that needs to be done to maybe spur that individual to start, contributing a little more to the board? Or maybe it's time for that person maybe to not be on the board. So there can be instruments within your bylaws to allow for when a board member doesn't fulfill their duties. One item on that, the same board that I serve on with all the law enforcement, in a 2-year period, we had an individual who served for 2 years, and I saw them at 2 meetings. So their term had expired. They were actually able to get another term, and the board decided, it's really not worth our time and effort to contact this individual, send them information each month, because they're just not involved and they're just not maybe as passionate about the organization as they used to be. So it's good to evaluate our board members' performance and have a means in there to get rid of them, if that's a harsh way of saying it, or some type of repercussion if they're not performing as we would like them to. Again, our bylaws should talk about board member term limits. These should be staggered to allow a natural turnover. That way we don't have 5 people coming off, 5 brand new people coming on, and we've lost our whole continuity of our board. So it's nice to have a staggered term. That way you still have individuals involved with the board who are very understanding, have keen insight on the organization, but also it allows the organization to not become stagnant. If we've got Susie, who's been on the board for 10 years, and we're just going to keep her going, and she's kind of our president. She's always been our main person. maybe we need to look at somebody else, maybe get some fresh blood in there, some new life to maybe change some things up. So it's good to have term limits to provide a natural turnover. Again, these should be defined in our bylaws, but we should appreciate and acknowledge our board members. We should thank them for their service and show appreciation that they've given their time, their talents, their resources to further our organization. Reviewing of governing documents, just wanted to touch on as organizations change, they need to look at their articles of incorporation, their bylaws, other governing documents. You know, it's 5-10 years since we did a strategic plan, or 5 to 10 years since we created our mission. Is that still the mission? Are we still serving the people we said we were going to serve 5-10 years ago? So it's just a constant looking at these governing documents to say, is this still who we are? And this kind of goes along with that. Looking at the mission periodically, approving strategic plan, looking at our programs and services. Are our programs and services today what we said we were going to do 10 years ago? And it might not be. So something needs to change, be it the organizational documents or maybe it's the programming of the organization. The last item in effective governance is board compensation. Most of what I've seen in my career would be where board members may get reimbursed for some expenses, for maybe going to a conference or something like that. But typically they're not paid. And if they are paid, there needs to be a rationale, and the amount must be reasonable, it must be documented, and it must be comparable to what other board members of similar sized boards, similar sized organizations are making. Probably my advice or recommendation would be don't get paid at all. You are doing a service. You are, again, probably passionate, excited about that organization. You probably shouldn't need to be paid. But again, that's just another way to get around conflicts of interest, things like that, just by not accepting any compensation.
All right, we're going to discuss strong financial oversight. Financial records, it's important that staff keep complete and accurate financial records, and that those records that are shared with the board at least quarterly. In most cases, I think those finances should be shared with the executive committee or a finance committee on a monthly basis, especially for smaller organizations that have fewer segregation of duties. If you only have a couple people doing everything and you're only seeing those financials once a quarter, you know, you're not going to get into the rhythm of knowing is something wrong, is something out of place, and you may be that internal control to make sure nothing is going wrong. And the timeliness of the financial information is crucial for the board to respond to any performance issues. You know, did you lose a funder? You know, if you find out about it 3 months later, you really can't react to it, you know, so it needs to be done on a timely manner. Many of the bylaws or grants or funders require an audit or review of the financial statements by an independent CPA. Independent, it even says it right there. The auditor should be hired and report to the board of directors. I don't always see this. I actually do some audits that they don't even ask me to come speak to their board. It is your responsibility to hire, and the auditor should be reporting to you. If they find something wrong, and they were hired by the executive director, and we don't have contact with the board, it's hard to report these items. So, you know, you should take ownership of hiring, and that communication should come from you. Board members should ask to speak to the auditors independently. All the good boards that I go to, I come and I present the financial statements, and then they ask all the management and employees to leave the room, and then that's when we have a candid conversation. Of course, if you have good auditors, if there's issues, you should have already got a phone call before the board meeting, but this would be the place and time for you to ask those questions. How is staff performing? Did you have any issues? Is there anything we should know about? For larger organizations, a separate finance and an audit committee can provide for an organizational check and balance. Probably for small organizations, not so much required, but larger ones, it's a good checks and balance. Budgets and key performances. Budgets are a key tool for managing not-for-profits. It's a yearly plan that can be used by management as a guide that has been laid out by the board of directors. The board should be actively involved in developing the budget. It shouldn't just be, the staff come in and saying, this is what we're going to do. You should question it. You should compare it to prior years. What funding do you see coming? What programs, should go away? I mean, this should be an active procedure that the board goes through. A monthly budget to actual analysis is going to identify problems and opportunities on a monthly basis. So when you're getting those monthly financials, you should have a column in there that says this is what we budgeted, and so you're going to know right away if things are going off track. It's an accountability tool between management and the board. You have the fiduciary responsibility, but they're running everything. This is your tool to make sure things are happening the way they should. Another key policy is an investment policy. Some of the key issues that need to be addressed in the policy you develop is, what is the risk tolerance of the organization? Do we have the knowledge to oversee the investments? I see this a lot, and Corey mentioned, this is a great one where you go out and get someone who's in the investment arena to be on your board. If you don't have that knowledge on the board, then I would suggest a foundation. They will have people that can come in and help you. But if you have a pot of money, you need to be the fiscal stewards of it, and if you don't have the knowledge on the board, you need to make sure you go find that. There's also questions of your minimum and maximum amounts of reserves that should be kept, and what are the guidelines for using that. So there are a lot of organizations that do get some big donations and have a pool of money. There should be guidelines for the staff, when they can use it, when they can't. Sometimes we do the board restricted, so you have to come to the board and ask before that can be used. Loans to directors, officers, and trustees. Loans to anyone in the organization is going to be perceived as a conflict of interest. The best practice would dictate that you just don't do these type of loans. If they are made, they should come to the board to be approved. The executive director shouldn't be approving any loan to an employee without the board being aware of it. The 990s asked for a disclosure for all loans that are made to officers, directors, or key employees. I actually did have a not-for-profit that executive director got in a little bit of trouble. They made her a loan. I come and do the 990. It was disclosed to me. We disclosed it in the 990, and they're like, I didn't know that was going to be disclosed. I mean, it's a public document, so now everybody knows that they made a loan to the public. It was an awkward disclosure, and I think had they realized it was going to be disclosed, they probably wouldn't have made the loan. Bottom line is the funds of organization should be used to advance your mission. So it probably doesn't fall within your mission. Loans like this are always going to be perceived in a negative light. Resource uses. A major part of your budget should be allocated to programs. Some watchdog organizations suggest no less than 65% of your total expenses be spent on program activities. With that in mind, adequate tracking and allocation of expenses is required for proper reporting of program, general administrative, and fundraising expenses. The board should be assessing these costs of your programs and your services, including staff time and overhead. For smaller organizations, when you're doing these allocations, your staff may need help from the board to actually do these allocations. You have an executive director. They don't just do programs. They do some fundraising. They do some management in general. You got to figure out how you're going to allocate the time of everyone. The Form 990 examines costs on a functional basis. So it's asking you to disclose that. If you don't disclose it and not required to disclose it in your financial statements, you have to do that for the 990. And prudent donors will look at these 990s and look for what percentage you're spending on your programs, and it could be the determining factor of whether or not they're going to donate to you. If you're only spending 50 cents of every dollar you get on programs, you're probably not showing the fiscal responsibility that you should. Expense policies. Corey hit on it a little bit, but you really should have a policy to establish guidelines for expense reimbursement. Plan should require a receipt for reimbursement. No receipt, no reimbursement. Unfortunately, more and more, I see the issuance of procurement cards to staff. You need if you have a procurement card, you need an expense policy that addresses what circumstances, what type of expenditures are appropriate, and under what circumstances should they be made. You should require receipts and an explanation for the expense, and there should be supervisory approval on those. Procurement cards automatically bring a higher level of risk, and internal controls in this area should be established and reviewed on a regular basis to make sure you're in line. I have some boards with the executive directors that, the board asked as auditors for us to look at the executive director expenses, as long as also with those expenses being looked at the board. So it's policy you should develop and have guidelines. Those procurement cards they're dangerous out there. The 990 also questions whether your staff is traveling first class or board members charter travel. So you need to have policies if there's a lot of travel going on. And if you do have a lot of travel, you should immediately just go ahead and address your travel companions. A lot of people, if they go out of town, they take their spouse. You should have a clearly written plan of who's paying for what in those situations. Board review of the 990. Why is the review of the Form 990 so important by the board? There's a few answers to that question. In many instances, the 990 is the only financial information that a potential donor is ever going to see. It's also an opportunity for nonprofits to present their mission and accomplishments to the community. The IRS has done studies, and those organizations that have board review of their 990 are more likely to be in compliance with tax laws and regulations. And it's also board's involvement in the process helps ensure transparency and accountability in top management officials while encouraging proper stewardship of resources. The organization, the 990, is asked to describe their policy of how the board reviews the 990. We did put attach a copy of the 990. For those that are board members, how many board members look at their 990 before it's filed? No. All right. You should be, and we realize as auditors that not every board member is going to be able to read. This is actually just the first schedule. There could be A through R schedules. This could be very thick. You should be, at least one member on your board should be able to read the 990 and understand it, because ultimately it's your fiscal responsibility that the information in here is correct. Yeah.
We do have one person that we're busy, but I'm saying here that it's probably something the whole board should take.
Yes.
care of,
Yeah.
at least once.
Yeah. Yeah, the IRS would like every board member to see the 990 before it's filed. They don't necessarily have to read every word. They don't necessarily have to understand all of it, but they should be given the opportunity to see it before it's filed. Yeah.
Would you mind repeating a statement you made, which said something about studies conducted
Yeah.
by the IRS?
Yeah, that's why I have it written down. It says, IRS has studied tax filings with the organization and concluded that nonprofits with board review of the process are more likely to be in compliance with tax laws. So just by virtue of the board members looking at this, they realize you're going to be more compliant. Makes kind of sense. It's a more involved board, so you're going to be involved in the whole process. I wasn't going to go over the whole 990, and you know what I see a lot more, especially with the new revised form a few years ago, a lot of boards ask us to come in and present the 990, just like we do the financial statements. Unfortunately, we don't always have that done when we present the financial statement. This is usually done after, but I think you wouldn't be out of your realm, especially if you don't have anyone on the board that understands it completely. Ask your auditors or whoever's preparing it to come in and discuss it. I was going to go over this, but we're running out of time, so I'm not going to go to but there is a page in here. I believe it's page 6 And granted that you have someone that is reading the 990 and understanding, this is the page that discussed your governance. Okay, so this directly applies to board members. It's asking, you know, how many board members were independent? Did you have any family relationships or business relationships that need to be disclosed? Did you document all your meetings? Section B is where it asks about all your policy, and it clearly says that the policies are not required by the IRS. This is probably not a document where you want to say, no, I don't have a conflict of interest. No, we don't have distract. You know, this is what donors are looking at, and if they're comparing this, you know, to the guy next door that's kind of doing the same process and they have these are just good, you know, fiscal responsible things that if you don't have these policies, nobody's going to ding you for it on the IRS, but they're asking it for a reason. They think prudent boards should have these policies. Okay, I was going to go in that more detail, but we're running out of time, so I'm going to let Corey do responsible fundraising.
Thank you. And I will probably skip through a few things just in the interest of time. Talking about fundraising and being responsible, the board should develop guidelines for promotional materials that go out to potential donors. Earlier I mentioned maybe having a fundraising committee who might look at this. It could be the executive committee, it could be the executive director, the CEO, but someone within the organization should be looking at materials that are going out to potential donors, namely looking at are they truthful and do they accurately depict the organization. Also, you'd want to note in those solicitations, you know, who is soliciting the contribution, who are we, what types of contributions will the organization accept, how will the contribution be used? Are we using it to build a building, or will it just be used to fund reserves so that we can continue on in perpetuity? And also, who can the organization contact if they should have additional questions? Talking about responsible fundraising, compliance with donors' intent, very important. Donors are the ones who give you the money that you use to further your mission, and problems could arise if a donor makes a contribution and specifies how the money can and cannot be used, and the organization doesn't comply with that. Typically, we see a couple types of restrictions, and I won't get into a big accounting debate or class with everybody, but the two types, temporarily restricted, so I may give you $10,000, you can only use it to run XYZ program, or you can only spend it after, say, 6 months has elapsed, or we typically see permanently restricted. And a lot of times we see those in the form of endowments. I may give you $100,000. I never want you to actually spend that $100,000, but go ahead and invest that, make money off of it, and you can use the earnings off of that investment to further the mission of the organization. So those are a lot of the two types that we typically see, and it's very important that when the organization is given donations with restrictions, that the organization understands those and that they agree to the terms of those gifts. Again, there can be some serious repercussions if a donor gives a gift with a restriction and the organization does not comply with those restrictions. Along those lines, we suggest having a gift acceptance policy. What will the organization accept and what will it not accept? It allows the organization to refuse gifts and not look bad in the eyes of a donor or in the public. Some items to look at, which these are typically non-cash type of items, will we accept real estate, vehicles, art, stock? Most organizations will accept stock, and a lot of them will turn right around and sell it with a broker. But these are ways, again, of what does someone want to give us, and can we say no if we feel it's best to say no and not look bad in the eyes of a donor or the public. If we're using a professional fundraiser, we've hired a consultant to come in, we're in a major capital campaign, we want to have oversight. We want to look at everything that potential or that professional fundraiser is doing from the very beginning all the way through the process. And we want to have a contract with this individual. Looking at fundraiser compensation, it should be performance-based. I've done some audit work for some clients where we're in a major capital campaign and we hire a professional fundraiser and they're going to get 50 grand. well, they just get 50 grand. They could raise 10 grand and we're going to pay them 50. Didn't really work out in our favor. So a lot of times you see that these are contingent on how much, the fundraiser will get paid X based on, raising Y. Talking about trends, if we look at a 5-year period on average, a nonprofit should realize charitable contributions from fundraising activities that are at least 3 to 1. So for every dollar that you spend on a fundraising activity, you should be getting at least $3 in a contribution from a donor. If your ratio is not 3 to 1, the organization should probably make some effort to inform donors or the public that we're working on getting that 3 to 1 ratio, or why a 3 to 1 ratio doesn't work for us. Missy talked about the 990. There are some special disclosures and additional schedules that have to be completed if you spend money on professional fundraising. I believe that's in the amount of like $15,000 or more. There are some additional schedules and things that you have to provide in your 990. Lastly, looking at donor privacy, this is very important. Nonprofits should respect the privacy of donors and safeguard the confidentiality of information that a donor reasonably expects to be private. The nonprofit should provide donors with the opportunity that to say that maybe I don't want to be on a mailer anymore, that maybe I'm tired, I'm fatigued by getting all of these mailings from all these organizations, so maybe don't ask me for a little bit of time, let some time pass. That should be okay and be allowed. Donors should be allowed to say, I don't want to be on a list that might be rented or sold or exchanged with another organization. Having privacy of your donor information is very key. Lastly, we talk about Schedule B. Missy noted on the 990 there is a schedule for contributions of $5,000 or more. Lists a lot of information about an individual. If someone were to walk in off the street and just want to request a copy of your 990, it's best to give them what's called a public disclosure copy. It will exclude that Schedule B and will remove that private information of those donors giving over $5,000. Now, I know it kind of went in fast on responsible fundraising as we're getting low on time. Again, these are the topics that we've discussed. We have thrown out a lot of information. Might open it up just for a couple minutes if anybody's got any questions. And again, here's our contact information. If something comes up later, feel free to give us a call, shoot us an email. We'll be more than happy to answer questions.
Thank you.